Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Markets are closed Monday for President's Day. So let's set up Tuesday, big picture from last week. Friday tried to calm things down, but the week still finished risk-off, led by selling in tech and anything tied to AI. That matters. We're heading into a longer headline window with cash shut on Monday, which means Tuesday's open is the first real verdict after everyone had extra time to rethink and reposition. On the weekly chart, here's how the majors shook out. The S&P 500 finished down about 1.4%. The Dow, down roughly 1.2%. The Nasdaq off just over 2%, and the Russell 2000 down just under 1%. The key takeaway isn't that Friday finish kind of green. It's that the weekly close still showed technical damage, with the Nasdaq the most bruised. That's your tell. De-risking hit where positioning was most crowded, mega-cap growth and AI. Now, the sector story, that's what really explains the tape. This past week looked like hide, hedge, and selectively buy. Money rotated out of mega-cap tech and high-growth names, the funding source, and into utilities and other defensive spots, with a few industrial and energy-linked pockets holding up better. That's not broad risk on, that's a market questioning its leaders and paying up for safety while it waits for the next catalyst. Over the long weekend, it's less about what traded on Friday and more about what can hit while cash equities are closed. The biggest story is structural. Monday's shut, so Tuesday can gap hard if a new narrative breaks. Crypto becomes your 24/7 proxy. Bitcoin was last referenced around 68,948, drifting modestly lower, so no obvious weekend panic. Yet, the unresolved tension is still the AI ROI and disruption story. If you see unconfirmed headlines pop up, treat them as chatter until they're verified. But be ready for fast repricing when cash opens on Tuesday. This week, the AI race took a surprising turn. Not in stocks, but in the bond market. Investors are asking a new question. What if the AI arms race gets financed with too much debt? Alphabet just raised about $32 billion in under 24 hours, even sold 100-year bonds, and demand was huge. No stress there, but behind the scenes, different story. Wall Street's been buying credit default swaps, CDS, basically, insurance against companies not paying their debt. A year ago, you barely saw CDS trading on high-grade big tech names. Now, they're among the most active. Alphabet has around $895 million of CDS outstanding. Meta's around $687 million. Oracle's protection costs jumped from about 50 basis points to 160 in a few months. More than triple. Why the shift? Because AI infrastructure is projected to cost over $3 trillion, and a lot of that gets funded with debt. Even the banks underwriting these massive data center loans are hedging their own exposure. Some deals are so big, they sit on balance sheets for close to a year. That's new. Here's the twist, hedge funds are on the other side, selling this insurance. Their bet, these trillion-dollar giants with fortress balance sheets will outperform if stress hits. So what's the signal? The bond market's saying, we love the AI story, but we want protection. It's not a collapse signal, it's not outright panic, it's early hedging behavior, and that's how bubbles can quietly start. Equities are cheering AI spending, credit's starting to price the risk. That divergence is exactly what we'll be watching next week. Here's a trend you won't see on an earnings slide, but it's quietly reshaping work culture. The rise of the 9-to-5 influencer. These aren't full-time YouTubers or TikTok stars, they're accountants, consultants, engineers logging into Zoom all day and posting content at night. They're building LinkedIn audiences, sharing day-in-the-life office routines, breaking down Excel hacks, reviewing office fashion, even documenting burnout. Why does that matter? Because personal branding is turning into career insurance. In a world of layoffs and AI disruption, your resume isn't just a PDF anymore. It's your digital footprint, your following, your visibility. And companies are still figuring it out. Is this free marketing? Or reputational risk? Is that employee an ambassador or a distraction? Under the surface, the signal is bigger. Work identity is no longer confined to your employer. People are diversifying income streams, reputation, and optionality. It's not loud like an AI bubble, but culturally, it might be just as transformative. The office isn't just a workplace anymore, it's content. And that shift changes the power dynamic. Heading into the next open, NVDA is still the AI beta switch. This past week's AI jitters, crowded positioning, and tech-led de-risking showed up most clearly in the Nasdaq, and NVIDIA sat right in the middle of it. Why does it matter so much? Because it often decides whether an AI sell-off snaps back or spreads. On Tuesday, don't overthink the first headline, watch the first hour. If NVIDIA can stabilize, it supports a relief bid. If it gaps down and can't find real buyers, the market may treat that as confirmation the unwind isn't finished. Microsoft is the cleaner read-through on enterprise AI spend and real economy adoption. This past week, the market started to question AI ROI and second-order disruption, and even the biggest balance sheets felt that pressure. Heading into Tuesday, the setup is simple. Can Microsoft reclaim its weekly structure and stop acting heavy? If it can, it takes oxygen away from the AI ROI bear case. If it can't, it says investors still want less duration, less growth, and more protection. Apple matters because it's not just a stock, it's a stability pillar for index psychology. This past week, weakness in mega-cap tech tightened financial conditions across the whole big tech as safety trade. Heading into Tuesday, Apple is on oversold bounce watch. If Apple can't bounce, even with a steady tape, that's a strong signal the mega-cap bid is still broken, and that can invite more systematic selling pressure across growth. Supermicro is a high-beta AI infrastructure name, and that's exactly why it's useful. This past week, the market punished crowding and kept AI-adjacent names volatile. Heading into Tuesday, SMCI is a quick sentiment read. Early strength would hint traders are willing to re-engage AI risk. But if it rolls over fast, that's clean confirmation that bounce attempts in the AI complex are still fragile. Over the holiday window, the cleanest real-time sentiment proxy is crypto because it never closes. Bitcoin was last referenced around 68,948, with modest downside which doesn't scream weekend stress. That makes GBTC a practical Tuesday watch. If Bitcoin holds firm through the holiday, crypto-linked equities can help lead a relief bid. But if Bitcoin breaks while equities are closed, GBTC turns into pure gap risk into the reopen. Heading into Tuesday, the calendar is your second big gap risk source, right after headlines. Tuesday brings the Empire State Manufacturing Index. Wednesday stacks durable goods in the morning and FOMC minutes in the afternoon, which can shift rate path expectations fast. Thursday adds jobless claims, Philly Fed, and pending home sales. Then Friday's the big cluster, advanced GDP, core PCE, flash PMS, plus new home sales. After a tech-led risk-off week, this data run will decide whether Friday's bounce turns into a base, or just a pause before the next leg down. To wrap it up, this past week was all about de-risking and rotation. Defense held up, tech took the hit, and Friday looked more like stabilization than a real reversal. Over the weekend and into the holiday, the smartest posture is humility because headlines can move faster than you can. So get some rest, map your levels, and come into Tuesday ready for real price discovery at the open. Then let the tape confirm the story before you commit capital. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.